Small cap stocks or smaller companies tend to outperform larger companies over the long term. The numbers don't lie. The average annual return in the S&P 600 small cap index over the past 20 years is 10.5%, compared to 7.9% for the S&P 500 over the same time. This difference is huge when compounded over the long term.
The reason for this, as you can imagine, is that smaller companies have better potential and opportunities for growth. As investment sage Jim Slater once said, elephants don't gallop, which demonstrates nicely the idea that big companies rarely double in size, but small ones can.
Think about it. HSBC has a market cap of around £113 billion and made a profit of £20 billion. This large cap is going to struggle to grow at a supercharged pace because, number one, it already dominates its industry and geographies, and number two, it's not a particularly innovative business. Many large businesses aren't.
Whereas if we take an imaginary company which has a market cap of only, say, £100 million, there is a good chance that it can innovate or do something better to gain market share. For example, a small company can take its existing products and simply enter a new geographical region to open new markets, new customers, and therefore more profits. We're not saying this is easy for a company by any means, but the opportunities are there.
Large companies such as Unilever cannot do this because they've already got worldwide exposure and their markets are saturated. What tends to happen is that large companies stop innovating and become cash cows. Once they hit this stage of their life cycle, they tend to just distribute cash to shareholders and invest less into the business. This just stifles growth further. Most small companies do not pay out chunky dividends and instead choose to plough it all back in to supercharge their growth, which leads to, you guessed it, more profits and faster share price growth.
The precise definition of small caps can differ wildly among investors. Some people's idea of small turns out to be quite big, which is why it's so important to understand what you're investing in, and not just assume that the name of the fund is in line with your train of thought. We'll get to how you can easily dissect a fund shortly.
In this video, we're going to talk about small cap investing, why they're awesome, why you can't always trust small cap index funds and ETFs, and how you can see through the fog, and our preferred method of investing in these rapidly growing businesses. We really hope you like this video. Let's check it out.
Welcome to MoneyUnshackled.com, the investing channel and website that sets you and your finances free. This is Andy, I'm Ben, and if you like what we say, hit the like button, click subscribe.
Don't forget to check out the MoneyUnshackled.com offers page, where we have hundreds of pounds of cash bonuses that you can snap up when you sign up to any of the investment and peer-to-peer lending platforms listed. We'll put the link in the offers page in the description below, so be sure to check that out. Let's get into the video.
What exactly is a small cap? As we said earlier, the definition of what a small cap is really does vary depending on who you ask. In the UK, the FTSE 100 is considered to be large caps, the FTSE 250 is seen to be mid caps, and anything smaller is the FTSE small cap. These three indices combined make up what is known as the FTSE All Share Index. However, this isn't all the companies listed in London. It makes up about 98% of the total market cap, and there are many more, even smaller companies.
Then of course there is the alternative investment market, AIM. Companies don't have to be small to be listed on AIM, but they generally are. If you wanted to get a fully comprehensive list of every company listed on the London Stock Exchange, including the AIM stocks, then we have found a great resource on the London Stock Exchange website, which we'll link to in the description.
An alternative definition of market caps that we like to use is the ones offered by Morningstar, the huge global financial services firm, not the communist newspaper by the same name. Why we like their definition will become evident later, but for now, they define their size groups in conjunction with regional areas. World equity markets are first divided into 7 style zones: United States, Latin America, Canada, Europe, Japan, Asia ex-Japan, Australia, New Zealand.
By the way, these areas look very similar to the Money Unshackled world portfolio that we constructed, and if you're interested in building your own world portfolio, then check out our videos. Anyway, those regions are then split into different size groups as follows. Giant, top 40% of capitalisation for each zone. Large, these represent the next 30%. Medium, the next 20%. Small, the next 7%. And finally, micro, the smallest 3%.
Why small caps can rocket power your investment returns. If you're still watching, you're probably already convinced that you need some exposure to smaller companies. Before we get into how to invest, we must recognise a downside. They do carry higher risk and tend to be more volatile. If you can stomach that additional risk, then awesome. Let's briefly expand on why small caps can rocket power your investment returns.
Number 1, smaller companies are less well researched. Large companies are tirelessly researched and analysed by analysts, brokers, traders and the media, meaning they are more likely to reflect their intrinsic value or actual true value. Small companies are far less scrutinised, meaning there can be incredible bargains to be found.
Number 2, it's far easier for small companies to double sales. We mentioned this earlier, but it's so important we thought we'd mention it again.
Number 3, a growing PE ratio. Smaller companies tend to have lower PE ratios than larger companies. Yes, there are some exceptions, such as a hot new technology stock, but generally this holds true. When the small cap starts becoming known due to increasing profits, there is a double positive impact for shareholder wealth. Not only does the market cap of the company increase due to increasing profits, but it also increases due to an expanding PE ratio.
Here's a quick demonstration. Say a company makes £10 million profit and trades at a PE ratio of 10. The company is valued at £100 million. If that company increases profits by 25% to £12.5 million, and the market now considers this a hot stock, so now rates it as worth a PE of 20, this makes its market cap £250 million. That is a 150% gain on just a 25% profit increase. Awesome!
Number 4, you can be an expert. You are never going to spot a secret hidden within a powerhouse such as Apple. For 1, you can't get close enough to the company, and 2, somebody else would have already spotted this secret and it will be public information.
You can, however, identify some killer strategy, product or trend that a small company may launch that you are familiar with. Expert or local knowledge is more likely to be worth something when evaluating small caps. In the book, The Naked Trader, Robbie Burns said he would look at what shopping bags his wife was bringing home. This would give him an edge regarding to what retailers were hot right now. Retail is an industry that can create giants very quickly and kill other companies overnight.
Number 5, AIM shares and inheritance tax. A little morbid, sorry, but for those of you with big sums, and worry the taxman is going to steal all your readies when you die, then investing in AIM stocks could be a strategy for you. Under current tax rules, a private investor, such as the likes of us, can qualify from an unlimited exemption from inheritance tax if they hold shares in a qualifying company for at least 2 years.
Don't always trust small cap index funds. Those of you who watch us regularly will know that we love index trackers and ETFs. But when it comes to small caps, they let us down slightly. There aren't really any truly small cap trackers, especially for UK stocks, which we think is due to the cost of running these and the difficulty in actually tracking them.
The ETFs and index funds that have the word small in their name are a little misleading, which is why we always say you need to understand what you are investing in. One foolproof way is to download the constituents of an ETF and analyse it, but we're going to assume that you haven't got the time for this.
A quicker way is to use Morningstar, and it will pretty much tell you everything you need to know. Using the iShares MSCI UK Small Cap ETF as a perfect example, we can see the average market cap and the breakdown by size. To do this yourself, you just need to use the search box to find an ETF and then click on Portfolio down the side.
Anyway, what we can see is that the average market cap is £2.1 million and half of it is invested in medium-sized companies. Not all small companies, as the name suggested. This looks eerily similar to the FTSE 250, which can be invested in for far cheaper than this so-called small cap ETF. Here we're looking at the iShares FTSE 250 ETF, and as we can see, it's almost identical. You can even quickly see the top 10 holdings on Morningstar, and if you do this yourself, you'll see that these funds are almost clones.
There's nothing wrong with mid-caps, and we both invest into the FTSE 250 heavily ourselves, but if you want truly small caps, or even micro caps, then what is the best way to go about doing this?
The best way to invest in small caps. Open-ended funds such as OICs and unit trusts are no good for this because of the liquidity issue that small companies produce. This was a major problem and cause of the collapse of all the Neil Woodford funds. This is because investors were abandoning his funds in their droves and Woodford couldn't access the money quickly enough.
The solution comes in the form of investment trusts. These will be actively managed, which is absolutely fine in our opinion when it comes to small companies. Because as we mentioned earlier, many small companies are undervalued. And a good investment manager can really show what they're made of in this area. In this situation, they can sometimes justify their high fees.
Because investment trusts are closed-ended, it means that the investment manager can focus on growing the value of the fund rather than on liquidity issues, which means they are a perfect vehicle for investing in small companies.
We expect many of you will just want us to tell you which investment trust to pick, but we think this needs to be a dedicated YouTube video in its own right to do it justice. If you guys would like to see this, let us know in the comments and we'll get it done.
Question of the day: are you now convinced that small caps are a must-have investment, or are they too risky? Let us know in the comment section. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.